Current market action on this Monday morning shows Beyond Meat Inc. trading at roughly 84 cents, that is 0.84 US dollars. We are looking at a decline of approximately 2.96% on the session so far. It is 10:03 a.m. Eastern Time. If you are just glancing at a ticker cape, seeing a stock trade for pennies often signals one of two things: imminent death or the buying opportunity of a lifetime. The expectation for Beyond Meat, once the darling of Wall Street with a valuation that rivaled major tech firms, was that it would redefine how humanity eats. The expectation was that by late 2025, we would all be eating plant-based burgers, and the cattle industry would be on its knees. The reality, staring at us from the screen at 84 cents, is a company fighting for its very survival in a market that has aggressively turned against it. This is not just a dip, this is a distress signal. But here is the twist that most people missing the intraday nuance do not see. Simply dismissing this as a dead stock ignores one of the most violent, fascinating financial battles happening in the small cap space right now. At 84 cents, Beyond Meat is effectively an option on its own survival. The market is pricing in a high probability of restructuring, yet just weeks ago in October, we saw this stock explode in a meme-fueled rally that defied all logic. That tension between the fundamental gravity pulling it to zero and the speculative fervor trying to rocket it to the moon is where the money is being made and lost right now. When you look at the volume today, it is relatively muted compared to that October madness, but do not let that fool you. Under the surface, there is a massive reshuffling of ownership. The tourist investors who bought the hype are capitulating, selling their shares at these sub-dollar levels to high-frequency algorithms and distressed debt investors who are betting on a binary outcome. This is not investing in the traditional sense, this is financial combat in the penny stock trenches. Most retail traders engaging in online investment or checking their Robinhood stock trading accounts look at the chart and see a disaster. They see a line that goes from the hundreds down to pennies. But professional traders using interactive brokers trading platforms see something else: volatility. They see a coiled spring. The recent debt restructuring news, which we will get into deeply, has bought the company time. Time is the most valuable asset for a distressed company. The expectation was that immediate liquidity failure in 2027. The reality is that management has successfully kicked the can down the road to 2030. That 3-year window is the difference between immediate bankruptcy and a potential turnaround. At 84 cents, you are buying that 3-year window. Is it a gamble? Absolutely. But it is a calculated one for those who understand the terms of the debt swap. Let's talk about the meme stock phenomenon that hit this ticker in October 2025. It was a classic short squeeze setup. You had massive short interest, people betting the company would fail, colliding with a sudden catalyst of the debt news. The stock surged nearly 1,000% in days. That expectation of the next GameStop drew in thousands of retail traders. But the reality of the fundamentals, shrinking revenue and negative margins, acted like gravity. The stock crashed back down. Now at 84 cents, we're back to the hangover phase. The speculators have left the building, and we are left with the true believers and the vultures. This is actually a healthier place for the stock to be. The froth is gone. We are now discovering the true floor price of the business. When you consider the landscape of investing sites and the advice given by robo-advisors like SoFi Invest, they typically steer clear of stocks trading under $1. This creates a liquidity vacuum. Institutional funds often have mandates preventing them from holding stocks priced this low. This forced selling pressure is likely part of what we are seeing today with that near 3% drop. It's not necessarily based on new bad news today, it's structural selling. Get this off my books because it violates our charter. That is forced selling. And astute investors know that forced selling often pushes a price below its rational value. If the rational value of Beyond Meat's brand and factories is $1.20 and it's trading at 84 cents because funds have to sell, that creates an arbitrage opportunity. But we must face the brutal facts of the business. The expectation was that plant-based was a secular trend, a permanent shift in consumer behavior. The reality in late 2025 is that the narrative has shifted to ultra-processed. This is the single biggest headwind for the company. Consumers are no longer asking, is it meat-free? They're asking, is it real food? The ingredient list of a Beyond Burger, which was once seen as a marvel of food science, is now being scrutinized by health-conscious influencers and concerned parents who want clean labels. This cultural shift is devastating. It's harder to fix than a supply chain issue. You can fix a factory. It's much harder to fix a reputation. The company is now in the position where it has to re-educate the consumer, and that is expensive. They don't have the cash for a massive global marketing blitz. They have to rely on the product to speak for itself. Let's look at the financials that underpin this 84-cent price. Third quarter revenue for 2025 was down over 13%. That's a double-digit decline in a company that is supposed to be a growth story. Gross margins are hovering around 10%. In the food business, that's perilously thin. You need margins to pay for the R&D, the marketing, and the debt service. The expectation was that as they scaled, costs would come down and margins would expand to resemble a tech company. The reality is that they are resembling a struggling commodity producer. This is why the valuation compression has been so severe. The market is no longer pricing it on a multiple of future sales. It's pricing it on liquidation value. However, there is a contrarian take here that needs to be explored. We mentioned the green computing efficiency in other sectors, but in food, efficiency is also key. Beyond Meat has been aggressively cutting costs. They have reduced their workforce, exited unprofitable markets like China's direct operations, and streamlined their supply chain. The reality that might exceed expectations is their target to be EBITDA positive in the second half of 2026. If, and it is a big if, they can hit that target, the stock at 84 cents is absurdly cheap. A company that is cash flow positive does not trade at distress levels. The market clearly doubts they can do it. The skepticism is thick, but management led by Ethan Brown is betting the farm that they can shrink their way to profitability. It's a dangerous strategy, but it's the only card they have left to play. If you are using a Fidelity trading platform or monitoring this on your Fidelity mobile app, you might notice the options activity. Even at these low price levels, the implied volatility is sky high. Put options are expensive because people are betting on a total wipeout. Call options are expensive because people are betting on another squeeze. There is no middle ground in the options market for Beyond Meat. This suggests that the smart money expects a violent move, either to zero or back to $2 or $3. Stagnation at 84 cents is the least likely outcome over the next 6 months. We also need to talk about the competition. Impossible Foods is the private elephant in the room. Reports suggest they are also struggling, engaging in layoffs and even pivoting to blended meat product, mixing plants with real meat. That's a massive capitulation for the industry ideology, but it shows the desperation to find a product-market fit that works for the average consumer, not just the vegan. Beyond Meat has stuck to its guns on being 100% plant-based. The expectation is that this purity is a weakness because it limits their market. The reality might be that it differentiates them as the true alternative brand when the dust settles. If Impossible blurs the lines, Beyond stands alone as the pure play. Whether that is a profitable niche remains to be seen, but it's a distinct strategy. For those engaged in self-investing, looking for deep value or turnaround plays, you have to assess the zombie company risk. Is Beyond Meat a zombie, able to pay interest but unable to grow? The debt swap deal suggests yes. They exchanged zero-interest convertible notes for higher-interest debt to push the maturity out. They essentially agreed to pay more interest later to stay alive. This hurts future cash flows. It's a heavy anchor to drag around. But in a falling interest rate environment, if we get one, that debt becomes refinanceable. If rates stay high, that debt is a noose. The macro environment is just as critical for BYND as its own sales figures. Let's pivot to the engaging part of the market psychology. Why do people still hold this stock? Comment below how many shares of Beyond Meat you currently hold and what your average cost basis is. Are you one of the